Ladies and gentlemen, welcome to another Independent View with your host, Lobo Tigre. Our guest of the day is Michael Gentile. I haven't actually met Mike before this, but a lot of my readers and a lot of my audience have mentioned him as a sound mind that I should speak to. And so I looked him up, I watched some interviews, and I was very pleased to see somebody who doesn't seem prone to, great hyperbole and is not a dyed-in-the-wool gold bug. This is an investor from sort of the broader universe who sometimes sees things the way, you and I do, dear audience. So I thought it'd be interesting that as we wrap up this year to get an outsider's view on what's going on. No BS, Mike. Are we gold bugs in for a world of pain in 2022? Or are things looking up? And beyond gold, commodities, metals and mining, that's our stuff. Maybe actually before we go there, why don't you introduce yourself a little bit for the members of the audience that don't know you? What is Bastion Asset Management that you co-founded, and who are you? Why should we listen to you?
Thanks, Lobo. Yeah, well, I spent about 17 years in the institutional money management business from 2001 to 2018. I was an institutional fund manager, and as you mentioned, Lobo, I was a generalist investor. I'd go across all sectors, but one of the first sectors I covered was the commodity sector. You can go back to pre-institutional days. As oil and gas, one of the first sectors I covered in the late 90s. So I've always been very interested in commodities, invested in commodities. But as you know, it's a very cyclical business. So there's good times and bad times to invest in commodities. I learned that the hard way over 20 years investing. But I'm also a generalist investor. So I've covered retail, healthcare, tech, industrial, autos, all kind of sectors over the years. And so that was my kind of 17-year institutional money management background. 3 years ago, I had beautiful twin daughters that were born. I already had a few kids before that. So I need to take a bit of time off from my institutional money management job. So I was kind of at home with my own capital, kind of just taking some time with the family, and really saw a huge opportunity in the gold sector in particular. And I saw a huge opportunity in the junior exploration sector. So kind of reinvented myself and became a strategic investor in the junior exploration sector, where I saw a massive opportunity, both from a cycle perspective, from a valuation perspective, and from ability to add value perspective. So the last 3 years I've been heavily involved investing in the junior exploration space. That's probably where many of your viewers may have heard my name as an investor in some of these companies that I've been backing with my capital. And I continue to see a very bright outlook for the exploration sector and gold in particular for the next several years. So I've kind of continued to make additional investments in the sector the last couple of years as well.
Well, that's really
And then
interesting.
Bastion Asset Management, sorry, second part of your question, Bastion Asset Management.
Okay.
I've got back into the institutional money management game, just recently co-founding Bastion Asset Management with a couple of my former partners. That's going to be going live in January. That's going to be institutional money management business, all sectors, again, generalist, focused on small mid-cap equities in Canada and the US. So kind of wearing two hats again, my old familiar hat and then the new hat from junior exploration, my investing over the last 3 years.
All right. Well, hats off to you for prioritizing family in that way. That's actually pretty neat. Not business related, not investable, but I just think that's really cool. Well done. Nicely done. But what you said there, before we go down the multiple rabbit holes, I just got to say, autos, tech, all these different things. These things come across my radar too, and I find myself looking at some of these opportunities, some new DeFi thing. That makes sense to me. That sounds like a really good opportunity, but I don't feel competent to judge that. I'm not a computer programmer, and I don't know if somebody else has a better mousetrap. How did you have confidence to invest in so many different areas? Do you just have experts that you really trusted, or are you, a Da Vinci style genius who can actually understand those different sectors so well, or how did you do that?
It's a great point, Lobo. I would say Warren Buffett has a great analogy called his circle of competence. So when you reach out of your circle of competence, your success rate tends to fall, or your chance of success is lower. So there's no doubt. My institutional money management days, I worked with a very talented group of people. So we had 7 to 10 portfolio managers, a bunch of analysts. So within the firm, we had individuals that were really deep in the weeds on tech, or deep in autos, or deep in healthcare. As a portfolio manager, your job is to sort of work with those analysts and those portfolio managers to surface the best ideas. And so having sector-specific expertise in your firm, as a larger firm, as an individual, it's harder to do, but as an investment management firm, you can have 15 people working. Each person can focus on a certain sector. And a lot of portfolio management is, good ideas level are multi-sector, right? You can recognize a good idea if you have someone who understands the technology, understands the industry well. Then it's really about timing, both in terms of cycles, valuation, and catalysts, and what the stock potential is. And that's a skill set that can be applied across a lot of sectors. So definitely leaning into expert networks and sell-side analysts and internal analysts you have in a firm to help give you that circle of competence. I wouldn't say that I'm an expert in tech. I wouldn't do an investment in tech without leaning heavily on those that know more than me. But the actual ability to time an investment through the cycles of greed and fear, understanding what the valuation is, what the real stock opportunity is. I think that can be spread over multiple sectors over time, which is why, I would say 10 years ago, I wasn't an expert in exploration investing, but I really identified an opportunity starting in 2018 to really roll up my sleeves and spent almost exclusively the last 3 years doing that. Your circle of competence continues to expand and expand and expand. And you get better and better at what you do. And obviously, relying on 20 plus years of investing in commodities, that was an easier extension than going into NFTs or cryptocurrency, something which is something newer and a little more learning curve to go through to understand fully how that works.
Alrighty, well, that would be an interesting way to frame. Maybe here we are at the end of the year. As we record this, it's December 29. Hopefully, we'll get this up before New Year's Eve, so everybody have a New Year's Eve present there. But that's, as you mentioned before also, and as you're saying now, the cyclicality, timing these things, not timing market tops or bottoms, but looking at these broad trends and as they go. It's interesting to me that over the last year, people have been talking a lot about the commodity super cycle as though they just discovered it or it just started. But as you said, you started in 2018, which coincidentally or not, that's the year I started the independent speculator when I went off on my own, started my own business. And I see commodity cycles as broad multi-year correlations that go on for a longer time. So you're nodding, so I guess you agree. Where would you say we are now in the cycle, and how do you see the opportunities that got you into this a few years ago? Are we late in the game here, or is there still most of the money to be made ahead? Where are we at, Mike?
Yeah, let me take a step back. Let me jump back 20 years just to give you a bit of perspective on how I look at commodity investing. So the first sector I looked at was oil and gas in 1997, 98. I remember there was an article in Maclean's magazine, Canada, that came out and said oil was $10 a barrel, and they based it the end of oil, and oil was going from $10 to $5. Their prediction was going $10 a barrel down to $5. That's the first sector I looked at as a young investor, was the oil and gas sector. Well, guess what happened? Oil didn't go from 10 to 5, went from 5 to 140, right? So what happened to oil in the 90s was there was massive underinvestment. So the supply side of oil got dramatically reduced due to lack of capital. And then you had a huge demand surge, which was the Chinese economy growing dramatically, starting to see a huge demand driver for oil. Demand for oil increased dramatically. So when you have a commodity sector where you have suppressed investment for 5 to 10 years, where there's no capital going in the ground, which means supply of that commodity will be reduced in the future, and you have a view that demand is going to increase, that's the perfect cocktail for explosive, as you said, 5-10 year cycle in a commodity run, right? So if you look at the metal sector, or even the base metal sector, the precious metal sector, what you have from 2012 until basically still now is a highly depressed environment. For 10 years, it has basically been $0 going to exploration, zero new copper mines, zero new gold mines really being built over the last 10 years. There's been no money. The capital sector has been starved for capital. And what lined up with me in 2018 when I took a look around said there's a massive amount of debt continuing to pile up fiscally in these fiscal governments and balance sheets of corporations everywhere that cannot be repaid. So I see a real driver, kind of price driver for precious metals. And also we can talk about base metals, EV metals as well in this if you like. So you have a situation where massive underinvestment, where I foresee increased demand for hard assets, precious metals, base metals, et cetera. That's a perfect recipe for a very long cycle, because the way cycles are resolved to the downside, as you know as well, Lobo, is when prices go up dramatically, well, that's when the investment spigots get turned on, companies get funded, they start overbuilding capacity, building too many mines, getting reckless with their balance sheets, and they eventually flood the market with too much of the commodity. We're so far away from that right now. Other than yourself, myself, and maybe a handful of our viewers here, very few people that I talk to are bullish on precious metals. Very, very few. So there's not like there's a overwhelming pool of capital or overwhelming sentimental positive in the precious metal space, which gives me the indication that we're still quite early in this sector, because the majority of the crowd is not interested in what we're talking about right now, which for me as a contrarian commodity investor is one of the most bullish signs you could possibly have. That's so how I see. So to answer your question, I think we're still very early in this cycle, maybe second or third inning, to use the baseball analogy. We haven't seen the fireworks even start yet.
Well, very encouraging. I'm sure the audience is loving it. But it's very interesting to me that as a person who starts from a generalist perspective, that you hone in on the precious metals in particular, and you see a demand case there. Most people think of the commodity super cycle. They're going to think first about the industrial metals, and then, the ugly stepchild, those precious metals, are those still important? What's the demand case there? Has Bitcoin not eaten gold's lunch? I hadn't actually planned on asking you that question, but since you've made this demand side case, we should talk about that, I think. Is gold 2.0 not going to derail your thesis? That's a devil's advocate audience. Please don't shoot me for that.
Yeah, for sure. Don't worry, I'll probably get shot for the answer on social media, but I would say Bitcoin is not gold 2.0. And I've said this publicly, I'm willing to take the heat. Bitcoin is a massive store of speculation right now. It is yet to be proven in any way as a store of value. It doesn't act like gold. It doesn't trade like gold. You have a lot of weekly charts in your emails, Lobo, that I appreciate, where you show the US dollar, interest rates, 10-year. If you take just the last 3 months as a segment, look at the last 10 times the market's gone down more than 2%. What has Bitcoin done? I'll give you the answer. When every time the market's down 1.5 to 2%, Bitcoin is down 3 to 4 times what the market's down. It's down between 6 and 8%. What has gold done those 10 trading days? Flat to up, right? So when people say Bitcoin's a store of value, it's completely false. It may be a store of value in the future, but right now, my definition of Bitcoin is QQQ, the NASDAQ ETF. It's triple levered QQQ. If the tech stocks are ripping and tech stocks are doing well, Bitcoin does well. If the market's risk on, Bitcoin trades up in general, right? When the market's down and the market's having a risk off day, Bitcoin trades down. So nobody wants a store of value when it's party on in the markets and you're making 50 to 100% buying wildly speculative instruments in the market. Nobody wants fire insurance when your house is not on fire. But when the house catches fire and the speculative stuff gets blown up, historically, what's the thing that's done the best in your portfolio? It's gold. It's a store of value, but it holds up value-wise better than any other asset class in a major market crash. And it's an incredible store of value and a wealth preserver in a hyperinflationary kind of fiat money printing world that we are strongly in right now. So why is gold not doing better, in my opinion, is that the fiat money printing machines are finding their way into Bitcoin, into real estate, into high yield bonds, into tech stocks trading at 60 times sales with no earnings. That's where all the money is going because it's easier and the party's there. Once the party stops, once the market corrects, once the fungible is taken away, that's when gold should start to assert itself and reassert its leadership in the market. But like I said, nobody wants fire insurance when your house is not on fire. But when it does, you'll find out what's flammable and what's not. And that's sort of what my prediction for Bitcoin is. If the market's down 30%, I'd be willing to bet you $100 the Bitcoin's probably down 50 to 70% during that period. That would be my call. There's no way that Bitcoin's going to be flat in a major market meltdown. And then we'll see how many believers of Bitcoin store of value talk we'll see in the future. That'll be the real test for me.
That'll be interesting indeed. And people need to remember, the crash of 2008, the last big one, Bitcoin wasn't there. There's really very little track record to go on one way or the other. So we'll just have to see. But again, just queuing off what you said, I love this conversation. I hadn't planned to ask any of this, but we have this demand case and we have this alternative. It's untested. We'll see. But we also have, as you'd say, taking away the punch bowl and all that. There's this huge entrenched, like obstinately, I think, bullheadedly stupid view that, taking away the punch bowl is going to be bad for gold. Raising interest rates, that's bad for gold. As though it's just the interest rate without the real rate context. But that's still programmed into the traders, right? We see it on a daily, weekly, monthly basis. These traders are the futures contracts. There's this knee-jerk reaction of, ironically, high inflation is bad for gold. So how do you see that, and what does that do to the demand case if, in fact, the traders whose prices we call the price of gold keep on treating high inflation as bad for gold somehow?
It's a fascinating question, but we could talk for hours about this. That's definitely something I've thought about too. I've said publicly that gold will only start to rally once tapering begins. I said that in August. We've been through a taper, then accelerated taper, and actually gold is up from where it was in August, slightly, marginally, but it hasn't been hit. And for a while, I was scratching my head going, and I still am to a certain degree, why is the gold market investors so spooked about tapering, but the rest of the equity market completely oblivious to the potential damaging effects of tapering, right? If you look at tapering and what that's going to do, I've had this conversation before with others where look at the 10-year bond today, it's 1.5% or so, right? 1.5%. Inflation is running 6 or 7%. Pick a number, probably higher. We could talk about fake numbers and shrinkflation, all those different things, but just say 6 or 7% is accurate. Well, if you buy a 10-year bond, you're signing up today to earn between 4.5 and minus 5.5% real return for life. So who in their right mind would sign up today to earn a negative real return, basically guaranteed for the next 10 years? Especially when Powell finally admitted reality after years of ignorance, saying that inflation is no longer transitory. So you are buying a bond with a negative real yield. You are guaranteeing yourself of losing purchasing power for the next 10 years when buying that instrument. Why are you buying it? Because the Federal Reserve for the last 24 months has been buying 30 to 50% every single bond that's been issued. So suppressing the yields, like not letting the bond market trade freely. The Federal Reserve has said, we're going to zero. We're no longer going to be buying any of these bonds. So you and I are capitalists, free market investors. What happens when the real negative rate is 4.5% on your bond, and you got to have an auction where the Federal Reserve is not there. That means Lobo and Mike Gentile have to be the marginal buyer of 10-year bonds. What's your opening bid for a 10-year bond, Lobo? I ask you, what are you going to pay? What's your first bid? I'm telling you, my bid is 10%, 8 or 9%, where I consider buying a 10-year treasury, given the inflation numbers and given the outlook I see for debt issuance in the US. We're at 1.5 right now. So the actual impact of tapering to me has not been priced into the market. I am highly skeptical that the Federal Reserve will make it all the way to zero tapering, let alone raising rates without creating a major meltdown or havoc in the bond market, because you're removing the largest whale buyer of bonds the last 24 months out of the market. When a whale market buyer gets out, typically the security trades down. And in the case of that case, yields are going to go way up. So that's point one. So if you're selling gold because you're afraid of tapering, the S&P 500 should not be at a 52-week all-time high, record high today, or yesterday it was in the market. That's completely nonsensical to me. So if you're selling gold because you're worried about that, sell your equities first, because the equities will get hit much harder if rates go higher. And the second point you made is real rates. My view is that with a $3 trillion a year deficit and $30 trillion of debt in the US, the only way the US can survive is real negative rates forever. If you look at $3 trillion and $30 trillion of debt, if you take a negative real rate of 5%, that's 1.5 trillion kind of carry. You're creating 1.5 trillion of interest for the government that they can carry off the negative real rates to fund their excessive spending and their debt they can't afford, right? So that is extremely positive for gold, because my outlook for real rates is negative forever, as far as the eye can see. And once the market realizes that that's a permanent situation, precious metal should trade much, much higher, I think, if they realize it's not a transitory negative real rate, but it's a structural, necessary negative real rate to be able to fund this excessive debt and excessive deficit spending they have in the US until otherwise notified by fiscal restraint, which I don't think we're ever going to see.
So, as a contrarian, that makes perfect sense to me. But the world at large just doesn't agree with this, Mike. What is the wake-up call? Like, people still look at the bond market and they have all these models and they invest based on these models of what the bond market is telling us, even though we know the bond market is massively, it's not an honest bond market, right? It's not a free market. So it hasn't been for a long time. But people still trade as though that was real market data and signals coming their way. Or people believe that the Fed has the tools, right? They can control inflation. Oh, it's easy peasy, right? Stop it in its tracks. What has to happen to wake people up that, G Toto, we're not in Kansas anymore?
So what's going to happen? So my first playbook is we need tapering to start for the gold market to have the conditions to lift off to new all-time highs. So we've got that. Check that box, right? The next condition is going to be at some point on this tapering curve, or at some point when they try to raise rates once or twice, you're going to have a major market moment where the bond market's not going to be able to clear. Once you take off you make the bond market free trading versus artificially suppressed by the Fed for 24 months. At one point, the bond market's going to price free trading because the buyers are going to know there's no longer the Fed put behind you. The Fed's not going to buy any more bonds. So now it's Lobo and Mike Gentile and other bond buyers who have to set the market clearing yield. There's going to be a day where the 10-year yield rips to 3% or 4%. When the bond market goes, the Fed's gone. Why am I buying these bonds with negative real yields? It makes no sense, right? At that point in time, yields rip. What happens to tech stocks trading at 60 times sales? What happens to the market trading at all-time record highs? The market discount rate is the 10-year rate. At 0% or 1%, you can justify any valuation you want on a discounted cash flow basis of any stock. Everything looks cheap. When that goes to 3, 4, 5, 6%, look out below. So my playbook is tapering, rates increase at some point in time, 10-year will spike, bond market will reprice to a free trading level. At that point, the equity market implodes, and somewhere along that curve, the Fed's going to have to come rushing back in and go, oh, sorry, we made a mistake, like they did in 2018. They came back in reverse course. That is going to be the turbocharging fuel for the gold market to make all-time highs, I think, in 2022 or 2023, when that is. I can't pick the exact moment, but that is the moment. So you need a bit of mayhem in the markets to show the market that the bond needs to reprice and that the government cannot afford 3, 4, 5% interest on their treasuries because there's just too much debt out there. So that is going to be the moment when they turn heel and come back for more QE. That's the moment where I think gold's going to take off. But the market's smart. They'll start to smell it. There'll start to be some cracks. You're already starting to see some cracks in the market. The smaller cap tech, high EV to sales tech stocks starting to roll over. The leadership of the market's becoming very, very narrow. Crypto's already rolled over 30% off the highs, and the market's making a new high. You're starting to see some signs of trouble. But when that trouble starts to intensify, at some point, the Fed's going to have to come back in and admit defeat. And then that's when you go real negative rates forever, because the Fed is truly trapped at that point in time. And the quants and all those guys who are operating under the Fed can do this, magic wand, we can handle anything. They'll have to admit at that point that they can't. That's when I think the shackles will be off gold, and then we should make new highs in the precious metals in that point in time.
That's very interesting. And well, I don't like to make these big headline grabbing predictions myself, partly because I hate being wrong, but even more because I wouldn't want to guide people incorrectly. I wouldn't say, the market's going to crash next March or gold's going to the roof next July. But do you have a sense of timeframes for this? Because that's a major event. It would help to know when as well as what, if you're willing to go there.
I'm with you, Ed. I'm not going to say, January or February or June or whatever next year, but I would say the elements for a market pullback are starting to accumulate here in the sense that the Fed is pulling the punch bowl back much too slowly, in my opinion. They should not be tapering at all. They should be raising rates immediately based on the economic data that we're seeing. But they're starting to pull the punch bowl away. And so, like I said, what we said about the bond market is equally important for the equity market. As that tapering happens and they go to zero and they start trying to raise rates, the risks for a market mishap are extremely high. So you're in that window now where they said, March, they'll be done tapering. So between now and March, they're done tapering. They're going to try to do the first rate hike. I'd say between now and June, pick your spot. I would be highly surprised myself if we don't get to June of next year without seeing a major correction, 10, 20%. We'll see the severity of that depending on how far the Fed goes and at what point in time they want to give up this tapering or rate increase pathway that they're on. But the risks are accumulating. And then you talk about valuations at all-time highs, complacency, margin debt, all those fun things, Santa Claus adding to the year-end rally here. To me, I'm quite defensive. I've been defensive for a while. People say you were defensive 6 months ago, the market's up again. That's true. But we're definitely in the later innings of this cycle for the market, whether it's a year left or 6 months or 2 years left, I don't know. But we're definitely very closer to the end than we are to the beginning of this cycle. And as an investor, you want to be pulling capital out of the market towards the end of the cycle and rotating into new emerging cycles. And like I said, I still think the gold precious metal cycles is early innings. So I think a smart trade would be to sell what everybody else wants, which is tech and the overall market right now, and rotate to what people don't like, which is precious metals, which are still early in their cycle. I think you won't be hard off by that. Worst case is you don't make money and your friends make a little bit more money in the market, but in terms of preserving capital for the next 3 years, I think that's a very good strategy to take some profits and rotate some in the precious metals when nobody else is really there.
Sure, and to use your metaphor, the time to buy the fire insurance is before the house is on fire. And if you never use it, that's what insurance is for. You hope you don't use it. You'd rather have the house, right? That's interesting. And I think another signal there, too, is just the fact that gold hasn't melted down, because we still have these traders still programmed. And to have the Fed's preferred measure of inflation, PCE, start hitting 30-year highs, and to still see gold at, as you and I speak, at least around 1,800. I actually think that's very bullish. People are pulling their hair out. Why isn't it higher? I'm just thinking, thank goodness it isn't lower, given the way these traders have been programmed to treat somehow high inflation as being bad for gold. So I do agree that there's a signal there. I think people are starting to get a clue, or at least get a little nervous about it, hedge their bets on that front. And then I wanted to ask, but before I go there, I want to ask about silver, but any last thoughts on wrapping that up?
I would just say the last thing I'd say is you're right on the gold price. You look at the Fed fund futures kind of pricing, and I haven't looked like the last couple of weeks, but you're kind of pricing in a 1.5% to 2% Fed funds rate by kind of 2023. I think that's the latest curve I looked at. So my view is that's what the gold market's pricing in. $1,800 gold's pricing in 1.5% to 2%, Fed fund rate, which means the 10-year rate should be 3 to 3.5. I take the under on that all day long, right? So in the sense that I don't think the Fed's going to get even close to 1.5 Fed funds rate. So if you believe that, you believe my thesis, and I can walk you through the debt picture again, all that kind of stuff. But if that Fed fund curve starts to roll down, which I think is going to happen, that's going to be wildly positive for gold, right? The gold market's being priced off that Fed fund curve, which I think is way too optimistic. So if that starts to flatten as people go, oh, they can't even get out of tapering, or the first rate hike caused massive havoc in the market, that'll be a major catalyst for gold as well. So I think you're on that trade, you kind of go, the odds of the Fed fund rate being higher than that is pretty low in my opinion. If that's already priced into the gold market, the upside looks pretty good to me from there.
Okay. So I don't know if you have an opinion on this. I haven't seen you speak about it before that I have noticed. Forgive my ignorance if you've been, out there about it. But do you see silver still very much as a monetary metal, or is it becoming an industrial metal these days? It's more important how much goes into solar panels and whatnot. I mean, we really saw a dramatic divergence last year for a few more days, right, in 2020. and how differently gold and silver reacted. And how, when gold fell off a cliff, silver did too, and then gold came back and silver didn't, and then later silver, very, very different dynamics over the last year and a half or so. Do you notice that? Do you monitor that? Does it matter to you? Do you lump them still together, or do you see them separately? Where do you stand, Mike?
I have a preference for gold. I don't have a dislike of silver, but I'd say I have a preference for gold for a few reasons. If you think about gold as a wealth preserver, or for wealthy people to preserve their wealth over time, it's pretty hard to physically hedge with silver. If you're very wealthy and you want to put $100 million to work in a gold market or say silver market, you have to pile up a heck of a lot of silver to really physically hedge yourself with physical silver versus physical gold. So I think gold is the preferred asset for kind of wealth preservation as a, fire insurance, as you call it. Silver, as you know, I've seen historically in my career, that silver really works when the gold market's on fire. Poor man's gold. It sort of catches on as like a little brother chasing the big brother kind of thing. And I think that's what happens. You really need gold to be racing to new highs, general market interest to be very, very high, retail participation, institutional participation in the gold market, and silver will then be explosive. Silver will typically outpace the gains in gold once the bull market in gold is really off into the races. So if you're wildly bullish on gold, I think owning a bit of silver is not a bad thing. But I think you may be disappointed in this kind of intermediate period where gold trades like the preserver of wealth and silver kind of trades a bit all over the place, whether it's industrial metal one day and then precious metal the other day. But I do think in a real bull market for gold and precious metals, silver is likely to outperform in terms of gold once you get in that stage of full acceptance. But this stage of the cycle, I still think gold probably outperforms silver for a while until that real bull market comes for gold.
Sure. Do you have a thesis as to why, when gold went over $2,000, silver didn't go over 50? Right, you had one hit a new nominal all-time high and not the other. That's the first time in 50 years of gold-silver bull markets that's happened.
I think even when gold hit 2000, I don't think we saw you have a better pulse than I do. We didn't see widespread retail participation like you did in the last kind of bull market for gold from 2008 to 2012. I think silver is much more of a retail you need the retail market to really jump in on the precious metal buying side and also on the commodity side, the stock side. So I think 2000 was really a lot of institutional money managers repositioning their portfolios for COVID and for zero negative rates and the avalanche of Fed money that was coming their way. And again, the preferred instrument for large money buyers is gold. When you need to see a real broad kind of retail major interest, generalist interest in the precious metals, and that's when silver will perform. That's what happened in 2008, 2012. That's the day I dream of, is a heavy investor in the precious metal sector, is when you and I are household names, so to speak, and everybody wants to speak to us because they're all moving into the sector. Whereas now we're kind of this obscure corner of the market where a few believers are with us. But that's when you need to see silver really sort itself when you have a real broad-based participation. That's my theory. We'll see how that plays out.
When the bartenders and shoeshine boys are talking about their stacks of gold and silver, that's
exactly
the Bernard Baruch indicator there. Okay, all right. So you're bullish on both. Silver still a monetary metal, may take a while to catch up. All good. Your thesis obviously spreads out to commodities in general, and if you see a difference there, do you want to dial in on, or is it bullish for all of them, or do you think the industrial commodities have a different path because of economic turmoil that comes with these kinds of disruptions that we're talking about?
Yeah, it's a very, very good bunch of different questions in that one question. So I'd say if we can do a quick rundown if you want. I'd say oil and gas, the way I look at things, I was really bullish on oil and gas when it hit zero, and I could see the demand destruction coming. So if you look at oil and gas, I'm quite positive on oil and gas for the next kind of 10 to 20 years. And why? It's that contrarian bent that I have, which I think you have to have in the commodity sector, which is the capital pipe is being completely shut off for oil and gas between ESG and pension funds and governments basically impeding any extraction of oil and gas, any investment in oil and gas. I mean, you have Canada as one of the top oil producing countries in the world, has basically gone to war on oil and gas, which shows you how toxic the environment is for oil and gas producers. But as an investor, you take away the ESG, take away your views on carbon and the environment. Let's put that aside. Just as an investor, when you have an industry that's being, again, starved of capital, where the supply is basically guaranteed to roll over, the companies are being punished for investing. They can't raise equity. They can't raise debt. They're just really punished for being in the wrong industry. They're out of favor right now.
Sorry, let me jump in, Mike. Let me jump in because I agree with that thesis. I think ESG is going to make oil go way higher at some point. But are we there yet? This is kind of important because you've got OPEC Plus right now saying, well, they're still struggling to complete their increases that they've committed to, but they are projecting a surplus. So in the near term, I think I question that. And if you got more, COVID shutdowns and
Yeah,
whatnot,
I'm just talking. I think
but
about
farther
commodities
ahead, I
on
agree.
five,
You're
10 year
you're you're
cycles.
cutting
Yeah,
off the
yeah. I'm not
supply.
talking about next week.
Yeah.
Yeah, I'm not talking about next week. I'm talking about 5, 10 year cycle. That's how I try to look at commodities. So I'd say if you look at what's happening to European gas, for example, right? They've gone to war on carbon in the UK. They cut off their investment. Norway went to war on gas. Everyone's war on carbon. Now, UK and European gas customers are paying all-time record highs to heat their homes this year. They're going, what the heck is going on? Because if you starve an essential industry like that, no matter what the environmentalists say, carbon is still 60, 70% or more of our energy footprint. You can't completely annihilate an industry until the bridge has been completely built to get to a greener future. So for the next 5, 10 years, we can say with certainty that investment in oil and gas is going to be underinvested versus the returns that otherwise would be available because pools of capital are being cut off day and night for those. Governments are becoming hostile to resource extraction, so it's harder and harder to develop new oil discoveries. And now you're playing with that OPEC kind of wedge of what they have to sustain additional capacity in the market versus incremental demand that I think will continue to stay flat or better longer than people think, because this bridge to green, EV battery metal cars is going to take a heck of a lot longer than people think to get there. So carbon is going to have a major part of our economy. So supply is going to be down dramatically, where demand should be better than I think. And so I think oil price in general will be higher in the future. And many investors will not touch these stocks like they wouldn't touch tobacco stocks in the 90s. Right? They didn't want to get anywhere close to them because they were sin stocks, they were bad. So you have less investors than otherwise would be investing, which means the valuations and the returns, those who are willing to invest in the oil and gas sector, should be higher. And that being said, I don't have a huge allocation of my personal capital in oil and gas right now. And the reason is, like you mentioned, these are cyclical commodities. So if we have an interest rate spike, which hammers the economy and causes a little mini recession or a pull down, oil and gas stocks are going to go down 50% because they are super sensitive to cyclicality in the economy. So my preferred moment to buy these stocks would be on the other side of the correction, when they get thrown out, like everything else will get thrown out in a cyclical downturn. And then you have the supply demand on your side, you'll have valuation on your side, you have very few investors that will buy them anyway because they're down, because they're not allowed to buy them from ESG or certain requirements they have for their funds. So that's a nice backdrop for a commodity in general. It's underappreciated that there's probably a better cycle than people think for the next 5, 10 years.
All right. And would not the same logic apply to Dr. Copper? Essential industrial mineral, if you're worried about tightening, causing a mini recession or a real one, would that not be cause for panic? And is not copper the new oil now, according to the ESG gurus out there?
Yeah, I think everything I said at the beginning about an 8 to 10 year underinvestment cycle in precious metals is also true for base metals. There's been zero investment in new copper mines from 2012, let's say, to 2020. So there's been a 10-year period with zero investment in the base metal space. So there's no new copper supply, been a dearth of exploration in the copper sector, and you have a huge demand turbocharge on the demand side for EVs, right? But electric vehicles, the whole grid, electrification of everything. So yeah, the supply side for copper looks really, really bright, and the demand side looks really, really bright, and the supply is going to be flat for several years until the market takes this price signal of higher copper prices and starts investing heavily in the sector, which we're starting to see slowly. So I think the outlook for copper is quite positive. The only difference between oil and gas and copper, I would say, I like copper structurally for longer than oil and gas because it's got a lot of legs to it, is that the market is more supportive of copper right now. So there is a better copper price, copper companies are getting funded, where oil and gas is completely left on the side, right? So I think 20-year cycle, you choose copper. 5, 10-year cycle, it's going to be a tight race between oil and gas and copper in terms of who has the most stock market return, because I think one side is completely unloved, one is gaining favor, but both have quite positive supply demand outlooks. But the final thing I'll say is that the same thing is true for copper that is for oil and gas. In the event of a market correction or a cyclical pullback, copper will see some pain as well because it's heavily tied to the economy. So that could be an ideal time to pick up some more shares of copper companies that you like in a pullback, because the demand is very good for the next 20 years, I think.
Or industrial metals writ large. All right, that brings to mind another thing, this ESG theme. You say copper is, it's not hated the way oil is. That's true, but it comes from these gigantic, most of it. I mean, there are small, high-grade underground mines, but they're actually pretty rare in the copper space. Most copper's produced from these gigantic open pit things. You turn mountains into valleys. You change the countryside, and that's getting increasingly protested around the world. And you talk about Canada going to war on oil. We tend to think of North America as being safer for investments for miners, but as these ESG thumbscrews tighten, you can find permitting getting harder everywhere. And it really makes me wonder. On the one hand, we need these environmentally friendly metals, or the new energy metals for the new environmentally friendly sources of energy. But we don't want it mined in our backyard. And how do you invest in that environment? I have my own answers, of course, but I see minefields everywhere. Mike, do you not?
And that's you get me started on something I'm really passionate about. But it's funny, these governments come and have these giant environmental summits, and they go to Paris and sign these accords and say we want to have zero carbon in the next 35 years. And these same governments, they systematically annihilate oil and gas, which is the bridge fuel to get them to a greener future. And the same governments also put, as you said, huge obstacles and roadblocks to permitting and getting these mines. It's almost like they have these spreadsheets where they say we need all our cars to be electric by 2050, but they don't do the reverse math and going, well, how many copper mines do we have to build? How many lithium and nickel mines do we have to build to get there? And we should be doing everything we can to unburden the permitting process if that's the trade-off you want to do. You're either going to have more carbon, or you're going to be digging giant open pits in parts of the world maybe you don't want to do, but you have to choose something. You can't just wave a magic wand and say in 30 years we're going to have all our cars be electric. There's a process that you have to analyze and build. So these governments are talking out of both sides of their mouth. They're saying we want a greener future, but then they're not doing things to make it easier to extract, produce, and acquire the resources necessary to make that transition, which is why I think copper is going to be higher, because the supplies might be there, but the permitting and the will of these governments to actually make it happen is not there. And the same thing is true for oil and gas, where there's supply available, but it's going to be completely annihilated. So you're going to have much higher cost of power to get around and move in our country for the next 10, 20 years until they figure out a real systematic plan, more than accords, a real business-like approach to how much supply of each metal do we need, and what are we doing as a global society to make sure that we have access to these metals. Otherwise, these plans are going to be, like most government plans, woefully off the mark and delayed and much more expensive and much less successful than they hope.
All agreed. Stock selection. How do you play this? Do you have a blacklist of no-go countries, or do you look at price versus risk and say, oh, well, it's already deeply discounted enough, so I'm willing to go there even though there's risk? Or how do you manage this? If you don't mind sharing, if that's not the secret sauce.
When I went to the junior exploration, so my old job, institutional money manager, my cutoff is sort of 200 million market cap or higher. So that kind of eliminated most of the junior exploration stocks just by liquidity market cap constraint. So when I dove in my own capital in 2018, I said, let me take the approach that I had as an institutional investor. And typically above 200 million market cap is either a mine or soon to be a mine, because they graduated from the junior explorer to a well-defined project where the market sees the potential to be built. So I tried to take that institutional approach and apply it to the junior exploration sector. So what are the characteristics, kind of the checklist of things that you need to have in a junior exploration company for that project to have a chance of becoming a mine? You've been doing this for a while too, Lobo. You know that I'd say 99 out of 100 exploration stocks you look at will never become a mine, right? There's a 1 out of 100 that actually make it. So I said this before, if I can pick 4 out of 10, I'll be the Warren Buffett of mining investing. Even a 2 out of 10 ratio is a fantastic ratio. But by 10 exploration stocks and you find 2 mines, 1, you'll be wildly wealthy because those stocks will go up 30, 50 times the ones you pick them early enough. And 2, that's a really good hit rate. So trying to understand what are the characteristics of a mine, grade, scale, jurisdiction, permitting risk, management team, capital markets, access, all those different things that you need to see to a successful project. Identify them as early on as possible in the story. Hopefully I'm in a bear market so I can buy those things really, really cheaply as well. So at the lowest possible market cap with the best quality project I can find. And if the management team or access to capital or something needs to be fixed, well, as a strategic investor at my level where I come in with owning significant stakes, try to bring some other elements to the story to help improve their chances of success in the future. So that's really what I've tried to do and why I love investing in bear markets, because in bear markets, you can actually pick off projects that look highly likely to become mines, trading at microscopic, speculative, haven't made a discovery yet valuations. In a bull market, these projects I'm picking up in my portfolio now should be trading at 5, 10 times higher than they are now. But because nobody cares, you can find some real gems in that 5, 10, 15, $20 million market cap range that you would never have a chance to buy in a bull market. Those would be $50, $100, $150 million market caps. So that's what I tried to do. And the more I rolled up my sleeves, the more opportunity that I saw in the space to get really good quality shots on goal at very low valuations, where I could also bring an element of improvement to the story and fix some of the things that were lacking to make that project a success.
Yeah, that's such an important point. The bear markets are the authors of bull markets, as Rick Rule likes to say. And, easier said than done. But really, I think of them as being like time machines, right? On the exploration side,
Hmm.
a bear market gives you a chance to buy after the discovery at the same price you could have bought before with none of that exploration risk. You already know who's got the discovery. Or you can buy after
Exactly.
they've built the mine, with none of the technical risk. You already know who's successfully got it up and running and making money. You know that, and you could buy at the same price that you could have before. All that risk was resolved. So, it's hard to walk that talk, but I agree. That's how the most assured money is made in this cyclical sector. Um, Lots of ways we can go there, but you've already given me 40 minutes of your time, so I don't want to abuse on it too much. But one thing I got to ask about, I don't know if you have strong opinions in this area or not, but we're talking about the new energy and so on, bridge energy. What about uranium and nuclear? Do you have strong feelings on that sector, and or do you have an outlook on the commodity and the related stocks?
Yeah, I think again these bridge fuels are definitely necessary. So I talked about oil and gas. If I'm bullish on oil and gas by default, I have to be bullish on uranium, and I think it makes a lot of sense. It's clean. It's in needed supply to have a greener future. I haven't made a huge investment in uranium. I've seen the supply demand. I agree with. I think uranium prices should go higher over time. My hesitation's been that in the junior exploration side in uranium, there's a lot of garbage. There's a lot of companies that are heavily promoted. The reason why uranium is valuable, Lobo, is there aren't many uranium mines out there. So finding a proven mine that's going to go into production on the uranium side at a low valuation is much, much harder than it is in the mining space, I've found, because there's just fewer projects and a lot of them are dubious quality and tend to be heavily promoted when the cycle gets going. But on a backdrop of commodities, let's say, like in terms of up or down next 5, 10 years, I would definitely choose up on the uranium side for the same reason. Lack of investment. Like I said, they're hard to find companies that are actually got a guaranteed uranium new project. Not in my backyard approach to uranium development. People are very spooked about it. They don't want to have uranium mines in their backyard. Even harder to permit than a copper open pit, I would say, the uranium mines is to do. So yeah, the supply side looks difficult to increase, and the demand should be up and to the right, because we need these cleaner bridge fuels to get us that carbon-free future, and uranium has to have a role in that. So I would say it's a positive outlook, and I think it's a good place to be with your capital. If you can find quality projects to invest in, or just buy the physical ETF, that's not a bad place to be either. But I think it's a positive outlook for that sector as well.
Well, very good. And we've covered a broad spectrum. We could probably drill in on more metals or commodities here or there, but I think we've covered enough of the space to give a take for your views. I think, though, that since you are a generalist investor, we should probably step outside that basket, because it is a mistake to put all your eggs in one basket. Even gold bugs and silver bugs should consider something else besides all gold and silver. What would be some of your favorite things that you would suggest to people who might find themselves over concentrated in metals and mining? What should they think about, Mike?
So in general, given that my market views are pretty cautious right now, I would say in general, I'd want to have a lot of cash in my portfolio. I think in general, it's a big overlay generalization, but in general, most other asset classes are either overvalued or extremely overvalued, whether it be, we talked about bonds, high yield bonds, junk bonds, corporate bonds, real estate, stock market, tech. Most sectors of the market are pretty stretched, in my opinion. So I would say if I was a generalist investor, I'd be pretty cautious. I'd have a bunch of cash. I'd have some precious metals, but I have a lot of powder dry for that inevitable correction that'll come. So they can be the only buyer when everyone else is getting margin called and forced off the field, so to speak, and forced sold into the market. Um, the new firm I started, Bastion, is a small mid cap focus. So that being said, what I love about small mid caps is that even though the market can be expensive, you can find individual stocks like you do in the mining space that are hidden gems or undiscovered that have huge amount of upside the market hasn't got around to. So by fishing in the smaller cap space, even though the tech market might be wildly overvalued in general, you could find that one or two tech stocks that are left on the side of the road that are not appreciated by the market or have major new product innovation that's coming that create a lot of value. Same thing in transports or financials or industrials. So I always spent my whole career in small mid cap for that reason, is that in general, if the market's overvalued, you can still find some really attractive companies in the small cap space because most institutional investors cannot invest in those. But in general, I'd stay liquid. I'd own some precious metals, and I'd be waiting for better opportunities in the market. I wouldn't be 100% invested, or definitely on a margin going into 2022. My advice for your viewers, I'd be a little more cautious into the new year.
You're not putting your life savings into NFTs?
Not right now, or the metaverse. Not right now either.
Well, hey, I've got a deal in a virtual house. I promise I won't sell copies.
Yeah. My wife hasn't asked me for a virtual purse yet, so I hope that when that day comes, I know it'll be the top of the metaverse.
Excellent. Excellent perspective, Mike. I really appreciate your time. I don't really have a hardball question. I usually ask people what's their skin in the game, that sort of thing, when I'm grilling CEOs. I'm just appreciative of your input. I'm kind of a metals and mining guy, and I like having some corroboration from outside. Is there anything else you think our audience, which tends to think along the lines that I do, is there anything else that we should think about? Anything that we might not be focused on that we should be aware of, particularly dangers that we should look out for?
I would say the expiration place, so that point you brought up, the money where your mouth is really important. So, any investment I make where I put my name behind something, I'm typically the largest shareholder, or number one or number two shareholders. So, I think it's really important in the mining space when you have executives coming on your show and talking to them. Number one question I always ask is, how many shares do you own? And how much dollars you put into the company? If you got all penny paper, founder's paper, and you put a total of $10,000 in the company, it doesn't excite me that much. And again, it's a relative basis. If someone's net worth is $100,000 and they tell me I have 75 grand or 80 grand of my net worth in this investment, they're heavily aligned with shareholders, right? If they're worth 5 million, they got 20 grand or 100 grand, it's not going to keep them up at night. So I think with junior exploration space, it's a hard game, a lot of sweat equity. You got to hustle, raise the money, make the right team, make the right decisions. Owning a significant chunk of the company or a significant percent of the net worth in that company is not a guarantee of success, but definitely gives you a higher batting average. So that'd be one thing I think is really, really important. And a second thing I think that's often overlooked by investment exploration space is how these companies raise money. I often bring up this point when I talk publicly, but I think it's really important. In the exploration sector, there's many different ways to raise money. And the companies that take the time to go find high quality, longer term, stickier capital versus the kind of fast money, kind of warrant clipper or kind of flow through money that will come in and out of the company very, very quickly, that can make a very large difference to your returns over time in exploration space. So companies that are thoughtful about how they raise capital, when they raise capital, and who they raise it from is also very important and often overlooked in the space. And there's a high correlation between thoughtfulness of capital raising and how many shares that management owns that typically are correlated between the two. So I encourage your viewers to look into that as well when they research their investments and really make sure they're aligned as investors with management teams that are also aligned and motivated for the same reasons they are.
That's an excellent point. Or as Rick Rowe likes to say, avoid the serial diluters.
Yes.
And to quote another one of my mentors, there's a famous story of Doug Casey being pitched some company. I wasn't there, but I have this from first-person witness that he gets up in the middle of the meeting and walks out. And my friend says, "Well, what are you doing? They're still, he said, well, it says right here in the presentation that management doesn't own any shares." And he just walks out. I love it. So I ask that question all the time. And in my own portfolio, as you.
If you own no shares and your only draw is the cash draw you're taking as CEO of the company, then you don't really care what price you issue shares at because you want to fund your salary for another year. I mean, it's a harsh comment, but it's true, right? If you own 20% of the company, you're probably suppressing your salary to avoid dilution that year because your net worth is tied to the equity in the company. So that's a really important thing to look at. Again, not everyone has access to capital, so don't expect every CEO to own 20% of the company, but make sure they put their own blood, sweat, and equity into the company as well. And they're not just there for a paycheck or a free ride on options, because that'll incite bad behavior in the future when things get tough and you're facing bad dilution decisions. You think very differently as an owner than you do as an employee, put it that way.
Absolutely. And yes, there have been companies founded by, recently he was a GO, now he's the CEO of this new company, and he didn't have a lot of money, but he put sweat equity in, he brought the ideas in. He's worked on his project for years, and I give credit for that. There is an equivalent to sweat equity in this space. All right, Michael. Yeah. Well, again, you've been very generous with your time. Really good ideas. I will be thinking about what you said. I appreciate it very much. I wish you a very happy and prosperous 2022. And everybody out there, I hope that you guys benefit from this as well, guys and gals. And we'll be seeing you on the other side.
Happy New Year to you as well. Looking forward to 2022.
Thank you for watching this edition of In the Pit with Lobo Tigre. If you enjoyed or found value in what you just saw, and you're watching this on any sort of social media, please do hit the like button and the share link. Send this on to anybody you think might be interested. That helps us out a lot. If you're watching this on YouTube, please do hit the subscribe button as well. The number of subscribers helps us get more valuable content to you as well. On the subject of subscribing, I'll quickly say that if you're not a subscriber to our free weekly Speculators Digest, I encourage you to sign up. I promise if you do, we will not send you a flood of daily advertisements. You get one free weekly digest with original research not published anywhere else. Check it out at independentspeculator.com. Thank you and have a great day.